Hey there, Scott Marks here, financial advisor in our Scottsdale office with another Financial Tip Friday. Today I want to talk a little bit about your credit score. It's something that you don't need most of the time, but when you do need it, you wish you had it. So it's important to keep an eye on that. And I personally use a website called creditkarma.com, and it sends me notifications if I ever open a new credit card or if I happen to have a credit pull for a mortgage or something like that. It always notifies me, so it's a good way to protect your credit as well. So there's really a few factors that go into your credit score, and I'll list those from most important to least important. So the most important is the payment history on your credit score, whether or not you've paid your payments on time, and if you've skipped any, delinquencies definitely impact that. The second one is the amounts you owe on your credit. So that includes things like mortgages or car loans, but this is mostly credit cards. And the thing to remember with this is that it is mostly related to your utilization ratio of your credit cards. And what that means is if you have a $10,000 limit and you carry a $1,000 balance, that means you have a 10% utilization ratio. And in most cases, a lower utilization ratio, less than 10%, is going to positively impact your credit score. So my typical suggestion, of course, is always pay off your credit cards before the end of each month. That's a good way to keep your utilization ratio low. The other way to do that is actually to get higher limits on your credit cards. So if you go and apply for a $20,000 limit and you carry that $1,000 balance, suddenly that's a 5% utilization ratio instead of 10. Obviously, don't spend the entire limit, of course. The next thing in line is the length of your credit history. So if you're younger, you might not have a ton of credit history yet. That's okay. It takes time. If you're older, you might have a lot of years of credit history, and that definitely positively impacts your score. The fourth thing is new credit. So whenever you take a new credit application, they're going to pull a hard report from your credit. That typically dings your credit score a little bit for a period of about 1 to 2 years. So it's something you want to keep in mind. You don't want to apply for too many pieces of credit within a certain period of time. And then the final thing is your credit mix. So in general, you'll get a higher credit score when you've had a mortgage that you've been paying on for some time, when you've had credit cards that have a good history on those as well, if you have an auto loan. All of that credit mix kind of plays into this as well. And the more variable credit, meaning credit cards, lines of credit, that kind of thing, that negatively impacts your score. Whereas if you have a mortgage, that typically positively impacts it. Now, in general, a credit score higher than 730 is going to get you the best rates on anything mortgage or car loan related. So there's not too much advantage to having it higher than that, though I always like to see it higher than 800. The maximum is 850. So if you want to set yourself a little life goal to get to 850, I think that's a great goal. And you need to just make sure you pay your credit cards off on time and get your mortgage payments on in time, and you'll get there in no time. Thanks for joining us again today. And as always, if there's anything we can do to help, please feel free to reach out.